The one that I think that we may focus on over the next few minutes is what is happening with the S&P, which is in and around its 100-day moving average. And that has been a great signal of late for dip buyers to come in. The question is this time different, but the question of the day is a fairly straightforward one. Is it time to buy the dip? Joining us now to discuss this, Eddie van der Walt of Bloomberg Markets Live, Abigail Doolittle joining us on set as well. Eddie, let me start with you. You wrote a piece that caught my eye first thing this morning. Cam's kind of followed that up with a whole load of other charts as well. This 100-day moving average has been a great signal. Is it going to work this time, or is this time going to be different?
Look, if Cam tells you today is a day to take your nose out of the spreadsheets, then you know it's a big day in markets. And really, I think it's been building up towards this, right? Because there's been, as you say, the year's just started off on this slightly tentative, slightly confused note with stocks pulling back, bond yields pushing higher. But every time over the past, really since the end of 2020, every time either we saw the 100-day moving average, or we saw stocks pull back about 3 to 5%. That's where the dip buyers came in. But here's the thing. If you don't see the dip buyers step in on these levels, if you see the 100-day fail and you see, the pullback going maybe to 6%, which we haven't seen for more than a year now, if we see those reliable indicators starting to fail for the levels at which the dip buyers come in, then I think it could turn really nasty. But it doesn't look like today is that day. It looks like today they're happy to come back on the bid again.
All right, so Abigail, obviously it's the 100-day moving average we're paying attention to with the S&P. With the Nasdaq, it actually breached that 200-day yesterday for the first time in, I think, 439 trading days. How significant was that move?
It's interesting, Kaylee. That is a tremendous test of support, of course. But I think that when we talk about these technicals, and I say this as somebody who loves the charts, we want to consider this all from a macro perspective. And what we have going on here is a real repricing of risk. As the Fed tries to normalize policy and the other central banks, it's a time when you're going to see, obviously, yields go higher, and that jitters through all of the different asset classes. That's a long way of saying lots of volatility. So if you take a look at the S&P 500 over the last couple of months, it's been going up and down, testing that 100-day moving average. Now, yesterday I was sharing with you and Guy that one of the old trade sayings is buy the first test and then sell the others. But this 100-day moving average on the S&P 500 has been very reliable. The fact that you have the Nasdaq down on its 200-day moving average, the Russell 2000 has been flirting with its 200-day moving average all year. That does say something, that there really is a war here between the buyers and the sellers. It's going to take time for investors to get comfortable with the idea that rates are going higher. Last year, if you recall, you had that 10-year yield back right up to 175, and then it caused a lot of jitters. Then investors got used to it, and then you had the Nasdaq 100 up a lot higher on the year. So I think volatility is the name of the game here.
Abigail, as you say, it has been rates that have been moving the equity markets. We've seen a huge repricing, a massive repricing at the start of this year in US rates. Any indications from the chart whether that move is over, how much more there is still to come? Because equity markets are going to take their cue from that.
They certainly are, Guy. And a very quick look at the 10-year yield, to my eye, would suggest that we're going to see 225 pretty quickly. Similar to last year, you had that 10-year yield. Once it went through 1%, it just took off for 175. These moves go further and longer than you could possibly think. So I would not be surprised to see the 10-year yield, that benchmark yield, go again above 2% really very quickly. That could cause the jitters that we're seeing. Think of this as a car. In terms of normalization of policy for the Feds, it's almost like a car stuck in a ditch. It's not going to be straight up. It's back and forth. Now, the yields, they could go straight up, but they're going to cause that back and forth for stocks. So I think, again, volatility as this repricing happens could be here for much longer than would seem possible, perhaps.
Well, Eddie, talking about how long volatility may stay around, it now seems like it's the March meeting and traders now pricing in more than a 25 basis point hike. Is that realistic in your view, and how would the market have to play catch up to that?
I think the market really has come out and really got behind the Fed narrative of a really hawkish year with several rate hikes. I think, even maybe for this year from the Fed looking possible if you're looking at pricing. The real question for me, though, is if we do see a significant sell-off in stocks, and we see there's nothing Abigail's right. You know, the charts are only important as long as they support the fundamentals. But again, nothing changes the narrative like the price. And if we see a big drawdown, whether the Fed will say, okay, hang on a second, maybe that hurts sentiment too much, and we pull back a little bit on our, on our expectations of a hike. I think really the Fed has given itself a lot of room to be dovish this year, right? And I think throughout the year, perhaps they scale it back just a little bit if inflation allows them to do so. And that way, the Fed can come in, through the end of the year, deliver 2 rate hikes, look dovish, and we see a very supportive environment for the equity markets.
That's a bit further down the road. We've got to deal with maybe the hawkish story unfolding a little bit further, Eddie. We're looking forward to that March meeting. I think there's a lot of concern around what is going to happen there and what the Fed is going to signal. We're in the quiet period now. We're not getting much commentary coming through from the Fed. You spoke this morning in your piece about the idea that there could be other catalysts. We've talked already about what is happening with yields. We've talked about what is happening with the charts. We've got the earnings story coming through as well. How are the dip buyers going to be looking at what is happening with the earnings story? Because the financials were meant to be one of the big areas that took advantage of the story of rising yields. However, we've had this flatter curve, which has unnerved them. We've got rising costs. Margins are being called into question. Eddie, if we're looking for other catalysts, if we're trying to think about what is going to encourage or discourage investors in the equity markets, the dip buyers, whether they come in or not, how important are earnings going to be?
Earnings are really important, but earnings are a little bit backward looking. And don't forget, we had Omicron and, this wave of infections that around the world and affected supply chains again and so on. So it's a little bit backward looking for me. For me, what I think the traders are going to care about are the anecdotal stuff, right? The commentary that comes alongside the earnings, what the CEOs, what the executives tell us they're expecting for the quarter going forward. Of course, that is always important, but the same for PMI and the beige book. Those are the 3 things that I'm really looking forward to tell me where we're going from here, because I think the backward-looking stuff, I think Christmas was a little bit cloudy this year.